What's happening, guys, and welcome back to yet another great video on our channel. Investing in stocks might seem like an easy peasy task, but with the daily advancement in the workings of the stock market, trading is no child's play. If you wish to get a kickstart in investing, then here's the ultimate guide to investing in stocks. Number 7, understand the workings of the stock market.
On this March 11th, in a couple of weeks, it'll be 77 years since I bought my first stock, and I paid $114.75.
A stock market is basically where an individual and institutional investors meet in public institutions to purchase and sell shares. Coming to what a stock, often known as a share, is a financial instrument that symbolizes ownership in a firm or organization and a proportionate claim on its assets and earnings. A company might sell stocks for a number of reasons, but the main reason is usually to crowdfund capital. Number 6, become financially literate.
And you're 100% financially secure with over $3 million in investments, and it's growing.
The stock markets have grown so complex and difficult to understand that the common man is unable to understand them. One of the biggest issues with ordinary people is that they're more likely to be financially ignorant. He may be a scientist or someone well known in his field, but when it comes to knowledge related to the stock and equity markets, they'll fall short. So starting off, you'll definitely need more training in order to have decent prospects in the stock market. You should also be able to read data. A common fallacy among beginners about reading data analysis is that you should invest in items that are going up and sell out if things seem to be going down. Now, while it appears to be a reasonable statement, you won't make much money if you wait for the market to react and change accordingly. When big swings in stock prices occur, much of the work is usually already done. So if you just follow the trend, you're not really gaining anything significant from the change. Furthermore, share prices only count if you're serious about making money through speculation, and only then. If you don't want to make money through dangerous speculation, you should look at various ways of appraisal, not just pricing. In essence, prices represent how much people believe a stock is worth, yet what people think about something has little practical value. People have gone crazy about cryptocurrencies, for example, yet there's no actual value attached to that type of money. It's entirely dependent on speculation, and although it has the potential to be extremely profitable, it also has a number of significant drawbacks. For example, Elon Musk, a pioneer of the cryptocurrency movement, recently made some critical statements regarding Dogecoin, causing the value of the cryptocurrency to plummet by more than 20%. Number 5, types of stocks.
And then we look at which companies behind those products generally have stocks that we want to own. We don't want to pay too much for them.
There are 2 ways to classify a stock. You can either do it by each stock's market capitalization, known as the market cap, or you can look at them holistically by the respective sector or industries. But that's a generic speculation, and when we talk about the 2 types of stocks, they happen to be a bit different concept. While there are 2 forms of stock, common and preferred, the word equity refers to common shares, since their aggregate market value and trading volumes are many orders of magnitude more than preferred shares. The primary difference between the 2 is that common shares normally have voting rights, allowing the common shareholder to participate in company meetings where topics such as the board of director election or auditor appointment are voted on, but preferred shares usually do not. Preferred shares are so named because they have a high priority than common shares in receiving dividends and assets in the event of a company's insolvency. Number 4, do in-depth studies of the stocks you wish to hold long term.
So many people are in it, and the frenzy is so great. Systems of management, the reward systems are so foolish.
Due to his enormous success, Warren Buffett, also known as the Oracle or Sage of Omaha, and his colleague Charlie Munger are renowned to conduct a thorough study on a company's gaining possibilities. They go into great detail and compare it to the stock's current market worth. For example, Buffett once calculated that the firm PetroChina had a valuation of $100 billion in 2002, but when Buffett checked the company's market cap, it was only $30 billion. He saw a good opportunity, and the company's valuation soared to more than $250 billion, netting Buffett profits of more than $6 billion. Number 3. Learn about stock valuations.
Compare one government bond with 5% coupons to another government bond with 7% coupons. Each one of those bonds has a different value because they have different coupons printed on them.
There are several ways to find out about the stock valuations of your desired shares, but there are a few pointers you should remember before getting into the technical details. If a stock's market value is undervalued, an investor should absolutely put money into it. Otherwise, if the market valuation appears to be overpriced, it's best to avoid that stock. A number of simple formulae can also be used to determine this. For example, you might use the price to earnings ratio to determine if the price of the company now on the market corresponds to the earnings the stock may potentially generate. Alternatively, you may check at the price to book ratio, which will tell you about the business financial leverage, or in other words, the number of assets possessed by the company via its capital and loans in the event that it chooses to dissolve. This simply tells you how much money a firm can collect in the event of a bankruptcy, as well as how much money it can pay you back. Number 2, be comfortable with your investments.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down,
you'll be furious with yourself if you lose money on anything and cannot explain why. Always conduct your own research and stick to what you're familiar with. As a result, invest in a company that you're familiar with. Never put money into a stock. Rather, put your money into a business. Also, never invest in anything you don't fully understand. Number 1, don't let emotions cloud your judgment.
When your retirement savings are on the line, if you're just getting started or if you're a seasoned investor, you can be seriously impacted by fear.
Many investors have lost money in the stock market as a result of fear, greed, and an individual's failure to manage their emotions. Quick wealth is tough to refuse in a bull market. When investors hear about spectacular stock market gains in a short period of time, they usually get excited. As a result, people accept the risk of buying shares in unknown firms without fully understanding the hazards. Fearful investors sell their stocks at cheap prices during a bear market. As a result, fear and greed are the worst emotions to have while investing in the stock market. And with that, always keep in mind that progression comes over perfection, and so definitely give yourself enough space to learn from your mistakes. So do give us your thoughts regarding all of this in the comments down below, and I'll catch you guys later in another video. Bye now!